Hi, my name is Roger Schluter. This video is actually about how banks obtain money to lend to borrowers. And I mean, a lot of people think that, they just create it in thin air or print it in the back or whatever, but they actually have to, get that money from somewhere before they lend it to you. And it is actually kind of creating money because, that when they make that loan, it's an asset on their books, and then plus they're giving money to you and you're spending it outside. So anyway, how banks obtain money to lend to a borrower. Number one would be customer deposits. And I know, banks attract deposits from people, they attract deposits from businesses, and then from other entities too. The deposits are a low cost source of funds to lend to borrowers. Banks pay interest on the deposits to encourage customers to keep their money with them. And then most of those are actually demand deposits. Their demand deposits are money that can be withdrawn at any time by the depositor. Most of these are like checking accounts and some savings accounts. Now, also you do have CDs and some savings accounts where borrowers put money in a bank for a length of time. And usually there's a penalty for withdrawing the money before the agreed upon term. The best loans are matched up with savings or deposit terms of the deposit. So a lot of times when banks make loans, they would also like to also have CDs for that length of time. So if they're fixing the loan for they're fixing the rate for, it's a 3-year loan, 3 years, and then they can renew it. But if it's a 3-year term and they have maybe the rates fixed for 3 years, they would like to match that up with a CD that's a 3-year CD or a 5-year CD. And actually, because then they know that money's there and is not going to disappear. That money's there for them to lend, and then when they get paid back, they relend it. So anyway, that would be basically your money that's demand deposits. And if you remember, demand deposits can be withdrawn. There is several banks that have either gone out of business or had problems because your customers, and this is not mainly individuals stay at a bank no matter what you do. I mean, I worked at banks that had bought different banks, and it seemed like these customers, no matter how much they thought they were abused, they never left. So it was kind of funny. So your customer base, your individuals usually stay. Now your commercial customers can leave in a heartbeat. Most of these have checking accounts. Some may have savings and some other things, but usually it's checking accounts. And some of these larger companies may have millions of dollars in these checking accounts. So if all of a sudden, you're a bank and you have, this $1 million from this company, that's in a checking account, and you start lending out that money, what happens if all of a sudden he comes in and says, I'm moving my money somewhere else, I'm pulling it out today, and then pulls it out and gives it to somebody else? So anyway, that can be a problem. So really you want to try to have money that's going to be there, not money that could be pulled out immediately. Number two would be equity capital. Now, equity capital is when banks raise money by the issuance of shares of stock in the bank. These are public companies. The shares can be private. It can be a private company and have stock. And also can be a public offering. We're a public company that sold in the New York Stock Exchange, whatever. So anyway, equity capital represents an ownership interest in the bank. Equity capital can basically do two things. One, it can provide money to lend or do whatever the directors of the bank see fit to do with the excess capital. Equity capital is very cheap money. It's the cheapest. It's where it's equity. It's not, you don't have to pay interest on it or anything, but the investors will want a return on their capital at some point in the future. So you do need to keep that in mind. Number two, the second thing is that equity can provide a cushion to the bank if the bank loses money on loans or any other investments that it has. If you have a large amount of equity, nobody's worried about how much money you have lent out or whatever. And that's kind of the same with companies. Companies that have a huge equity base banks or anybody else is not going to worry about lending to them, because they figure, they've got all this money sitting there, whether it could be used in the business, but it's still equity, it's not borrowed money. So anyway, the third thing would be the banks can actually borrow from other banks. Banks can borrow from other banks and financial institutions, or they can actually from the central bank. These borrowings are usually short-term and can include interbank loans or borrowing through repurchase agreements. So anyway, you can borrow from other banks, and it's done every day, usually on a short-term basis. Wholesale funding. Banks can access funds through the wholesale markets by issuing debt securities. They would issue bonds, or they would issue commercial paper securities that investors, on the other hand, mainly institutional investors and financial institutions, would purchase these securities as an investment, providing additional funding for the bank. So this is another way the bank can get funds to go ahead and lend out. Number 5 would be central bank funding. In most first world countries, banks have the ability to borrow directly from the central bank, whoever that may be. Most central banks usually they serve as a lender of last resort to the banks, and they also provide banks with liquidity during times of financial stress. So if you've got recessions and things, sometimes they have to provide liquidity to the banks so the banks can stay in business and wait for better times. Once banks obtain funds through these sources, they use the money to provide loans and other forms of credit to borrowers. Banks earn income from the interest charged on the loans that is used to pay operating expenses and make a profit for depositors and shareholders. Banks operate under a regulatory framework that requires them to maintain a level of capital and a level of liquidity to ensure stability for depositors and for investors. This is there's most banks will say we don't want any regulation at all, but people that have seen banks go out of business realize that they do need some sort of regulation, just to make sure that they're keeping enough reserves. Money deposited in banks is usually guaranteed up to a certain amount by the central bank or the FDIC, Federal Reserve of the government, but the FDIC is basically the one who guarantees most banks' funds. I think most banks, FDIC is guaranteeing up to $250,000 per account, per bank, that bank per account, and then also for that individual. So you could have husband and wife that could each have 250, that's 500, or you could also, if you have a business, they could also do it, and that would be different from the individuals. So there's ways to make that a lot more, but that's not that much when you consider some of these large businesses that have millions of dollars in their checking accounts. Come on, that little 500,000 or whatever is not a whole lot. So anyway, please subscribe and hit the bell to be notified of future videos. Please also like the video if you learned something or you like the content. My name is Roger Schlueter, and I will definitely see you in the next video. Thanks.